Good morning, guys. Welcome to Mug Briefing. ABC had already filmed an entire new season of The Bachelorette, 10 episodes, about $5 million each, roughly $50 million spent. The premiere was locked for March 22. Then, just days before launch, everything stopped. A resurfaced video showed the lead, Taylor Frankie Paul, in a 2023 physical altercation involving her ex-partner, Dakota Mortensen, with a child present. That changed the equation overnight. What was supposed to be a routine TV launch turned into a brand risk decision, and ABC, owned by Disney, pulled the season on March 19th and replaced it with a rerun of American Idol. Here's where it gets interesting. Financially, this flipped from a revenue-generating asset into a sunk cost problem. Sunk cost just means money already spent that you likely won't get back. That roughly $50 million production budget, that number comes from reporting and is best treated as an estimate, not a line item Disney has formally broken out. But the direction is clear. Most of that spend is already locked in. Now the real question is recovery. How much of that $50 million is gone for good? Right now, there's no confirmed reuse plan for the filmed episodes. If the season never airs in any form, the majority of that production spend becomes effectively unrecoverable. If Disney finds a way to re-edit, delay, or quietly distribute it later, they could claw some value back. But today, that path is uncertain, and that's only part of it. Marketing spend also matters. Promotions had already started ahead of the premiere. Trailers, ads, placements, those dollars are now partially wasted. There's no confirmed number, but in TV launches, marketing can run into the millions. Not as large as production, but still meaningful. Now shift to revenue. This season was expected to generate advertising income across its run. That's now disrupted. Some advertisers had already begun pulling back, according to reporting. That part is partially confirmed, but not fully quantified. We don't have a clean number for expected ad revenue versus what will actually be realized now. Instead, ABC is filling the slot with a rerun, and reruns typically earn less. Lower viewership, lower ad rates, sometimes significantly lower. So the financial gap isn't just lost show, it's the difference between fresh, premium programming and recycled content. That gap directly pressures margins, which is basically how much profit they keep after costs. Now, zoom out for a second. You might expect the stock to react sharply, but Disney shares barely moved, around $99.51, up about 0.30% after the news. No clear sell-off tied to this event. And this is why. In the context of Disney's total size, $50 million is tiny. It's roughly 0.025% of the company's equity value. For a business this large, that's not enough to shift the overall financial picture. The market sees this as a contained issue, not a system-wide problem. But that doesn't mean it's irrelevant. It just means the impact sits at the segment level, specifically ABC and Disney's entertainment networks. So what actually changes in earnings? Most likely, this shows up as either a one-time hit or softer margins for the quarter. Margin compression simply means they earn less profit on each dollar of revenue. The production cost is already spent. The replacement revenue is weaker. That squeezes profitability. The key unknown is scale. If losses stay near the $50 million range, plus marketing spillover, the impact on Disney's total earnings per share, or EPS, or profit per share, is small. But if advertiser pullbacks expand or additional costs appear, the impact grows. Now, think about who else is affected. Advertisers who planned to run during the season now need new placements. That budget doesn't disappear. It likely shifts to other shows, networks, or platforms. That could benefit competitors in the same time slot. Production partners and vendors? It depends on contract structure. Some costs are fixed and already paid. Others may have shared risk. But from what's visible, Disney appears to carry most of the exposure. And this raises a bigger question. Is this just a one-off mistake or something deeper? The narrative forming around this is not about money, it's about process, specifically content vetting. How did a lead with this kind of background make it through casting? That's where investors start paying attention, because if this is seen as a pattern, weak due diligence, reactive decisions, it can slowly affect how the market values execution quality. Not in a dramatic way, but in subtle ways. A slightly lower confidence, a slightly lower premium on the stock. But that's only part of it. Disney's core business, parks, streaming, major franchises, remains unchanged. This event doesn't hit those engines. It doesn't alter long-term growth drivers. It doesn't justify a major valuation reset on its own. So for investors, this sits in a middle ground, too small to move the stock today, but not meaningless. What matters next is what happens around it. Do more advertisers pull back? Does Disney confirm any write-downs, which are formal accounting losses? Did they find a way to reuse the content? How does the replacement programming perform? And do future shows face tighter controls or delays? Because the risk isn't the $50 million already spent. The risk is if this starts repeating. If more cancellations happen, if advertiser trust weakens, if franchise value erodes, that's when a small story becomes a bigger one. On the flip side, if Disney tightens its process, avoids repeat incidents, and contains the fallout, this fades into background noise. So right now, the market is treating this as a contained misstep, but it's also quietly watching whether it stays that way.